Well, hey there, everyone. Happy Monday. May the 4th be with you. With you. Uh, Great to have you here live on the live stream. My name is Dave Keller with Market Misbehavior. This is Chart This with Dave Keller. It is a beautiful summer day here in Redmond, Washington. Little warmer than we signed up for. Moving to the Pacific Northwest, we got highs in the 80s today. We are comfortable with sort of the upper 60s, low 70s kind of highs around these parts. But hey, hanging in there. It's a beautiful day, and it's great to be here with you today, looking at the charts. Not a great start to the week, and we thought about this over the weekend. Given some of the headlines coming from the Middle East, certainly seemed like there would be some challenges to the session today. This is after Friday flashing some shooting star candles, which we talked about on the show. If you caught Friday's all mailbag episode. And so, not surprisingly, between the shooting star candle on Friday, between the less than ideal news coming out of the Middle East, implying that hostilities are not near done at the particular moment, risk assets going down. We've talked about this in the month of April, right? I think we have a pretty clear bad news from the Middle East playbook. Pretty clear what's happened anytime we've had a bad headline after hours. The next day, we get weaker stocks, weaker bonds, higher interest rates, higher oil, weaker precious metals like gold and silver, generally weaker crypto, although this is one day where that actually didn't happen. Energy sector at the top of the list, most sectors down. That is, and volatility up. That has been kind of the general playbook. So except for cryptos, which had a pretty decent day, this is pretty much exactly what you'd expect given the news out of the Middle East. And so what that tells me is the market is not generally pricing in a high probability that this lasts very long. Otherwise, the markets would be going down, because we see what happens when the headlines get just slightly less good. Imagine if something would significantly erupt and we'd get back to sort of a heavier level of hostilities. I think that would probably be bad for risk assets. That's fighting the trend of remarkably strong earnings, which was pretty much the story last week. The good news is we got a lot more earnings to talk about this week. As we get to our market recap, we will check in on Palantir, which is an earnings reporter today. Plenty of other names, not all that we will get to, but we'll also talk about some of the key kind of macro charts, because volatility is back in vogue here. We're live streaming, by the way, on Facebook, LinkedIn, YouTube, and X. I appreciate you guys tuning in live. I see the usual crew here in the chat. Welcome, everybody. Please ask questions, anyone, as we go. If you're tuning in live, you are welcome to ask questions. And if you're watching the replay later on our YouTube channel, hey, drop a question in the comments section. We had a great all mailbag episode on Friday that I hope you caught. A lot of really good questions answered. All right. S&P 500 down 0.4% to 7,200. The NASDAQ composite a little bit less negative, I guess, down 0.2%. The Dow, the worst performer, down 1.1%. Mid caps, small caps, all down. So small caps have basically been following their traditional role of being good offense in uptrends and bad defense in downtrends, meaning it's tending to outperform on the up days and it's tending to underperform on the down days. And that's kind of what we're seeing here today. Volatility back higher, right? The VIX, which finished the week around 17, today briefly pushed above 19, right around lunchtime Eastern, up 1.3 points to get into the end of the trading session. So that's 18.3 on the VIX. Anything below 20 is still kind of fine. It's still low volatility. It still tells you the market's not pricing in big daily swings in the major averages, but that is one of the release valves that I always look for, right? When the market's good, when we're at near new all-time highs, it's all about assuming that trend is going to go up until proven otherwise. And a couple of the signs that I look for are spikes in volatility, spikes in spreads, spikes in defensive sectors. We're seeing maybe one of those here with volatility starting to pop up a little bit. We'll see. All right, looking at the fixed income markets, you can see bonds sold off, as did stocks. So the 10-year yield kind of pushing higher. The long bond yield's back above 5%. 10-year point getting closer and closer to 4.5%. It's right around 4.45 to finish the session. You know, I think of the 10-year treasury yield a lot like I think of crude oil, right? Crude oil sitting above $100 a barrel just starts to weigh in on optimism, because it's just fuel's more expensive, costs more to travel, costs more to ship stuff. We're seeing the impacts of the disruption in the Middle East in the form of higher crude oil prices. Clearly, the economy can weather higher crude oil prices for a little bit. Are there ripple effects to the disruption in supply? That is something I still see very divergent opinions on. What happens if crude oil sustains a move above $100 a barrel? That's something I think that is still open to quite a bit of speculation. So we'll see. And I would say rates pushing higher. Imagine if the 10-year yield pushes above 5%. That's just not great, right? Because that starts to weigh on optimism for economic growth because it just costs more to borrow money. And a lot of companies are borrowing a lot of money to grow and to fuel the euphoric expectations, shall we say, for earnings in the coming quarters and coming years. So for now, market's telling you it's not that big of a deal, but interest rates and crude oil higher for longer could definitely weigh on these markets very, very quickly. So bonds moving lower today. The dollar slightly higher, and that's another sort of warning sign to look for would be spikes in the dollar. Seeing a general uptrend in the dollar here to start the week. Looking at the commodity space, the DBC is really driven by the energy component. That's the biggest weight. DBC is a broad commodity ETF, so it has a little of everything, but it's really most heavily weighted to the energy space. So stronger crude oil, natural gas is going to definitely push the DBC higher, made a new high today. Crude oil prices, again, are elevated. The USO was up over 3%, natural gas up over 2%. Gold and silver, the precious metals, moving in line with equities, so both down today. The GLD down 2%. As I mentioned, in case you missed it on previous episodes, I've lightened up my gold position pretty decent amount, I would say, given the fact that it's not going up and other things are. And that is the essence of my trend following process, is follow the momentum. I have the quote on my monitor just below the charts that I'm sharing with you during the show from Hamilton: follow the money and see where it goes. That is my friendly daily reminder to just focus on the charts, focus on the trends. That represents where capital is flowing. It's not flowing into gold right now, and it's a bit of a risk-off field. It's not a horrible chart yet, to be clear. It's still above the 200-day moving average, but definitely appearing to make a lower high here and rotate lower. Silver, same issue, unfortunately. I mentioned cryptocurrencies kind of differing quite a bit from other risk assets. Most risk assets down today, but Bitcoin, Ethereum, and most of the top 10 coins actually pushing higher. That's after a pretty decent weekend. Bitcoin over the weekend got up into the upper 70Ks and currently trading just above $80,000. All right, looking at the 11 S&P sectors, only 2 of the 11 finishing in the green. Energy up 0.9%. That's the XLE. I did a special earlier today, excuse me, for Stock Charts TV covering my top 10 charts to watch for May. And I only picked one energy stock. A lot of them look very similar. I took Diamondback Energy, ticker FANG. But there are a lot of stocks in the energy sector that have that kind of look. Kind of had a big move, bit of a pullback in April, and now just rotating higher, making a new swing high to start off the month of May. And the XLE continue to push higher. Crude oil prices remain elevated. That's great for energy companies, and we're seeing that reflected in those charts. Technology number 2, it wasn't a particularly great day for technology, as you'll see on the heat map, right? There are a lot of things that are actually flat to down, but it was enough for the XLK to finish slightly in the green. Then we get to all the sectors that were down today, and the laggards today were materials and industrials, 2 of the cyclical sectors, both down over 1%. And then the 2 consumer sectors were kind of tied for third from the bottom, with both of those down 0.8%. All right, looking at breadth conditions, we can see that the breadth was not great today. The best breadth was in the NASDAQ with 55% decliners and 41% up. But the rest of the breadth was pretty bearish here. On the New York Stock Exchange, 27% advancers to 70% decliners, almost a 3-to-1 ratio. That was pretty consistent across the different cap tiers, more like a 2-to-1 ratio of decliners versus advancers in the S&P. But all of these are fairly negative breadth, except for the NASDAQ breadth, which was more neutral, but skewing to the negative side. This was a distribution day in terms of sector movements, distribution day in terms of breadth conditions. And, again, as always, right, when we have a market that's in an uptrend, the market made a new all-time high last week, right? So we're in an uptrend. And we've pulled back here to start the week. So what are the things we're looking at as the S&P is making new highs? This is something I talked about with my market misbehavior premium members over the weekend in our weekly report, our weekly flight plan. And as a taste of what we talked about, basically the things that have not been confirming this uptrend: weaker breadth, really weaker volume, right? If you look at the SPY, the volume in April was pretty meager compared to February and March. So market moving higher on weaker volume, market moving higher on weaker breadth. Offense over defense, favoring defense in the last couple of weeks. So it's not everything's great, right? As much as the index is making new highs, which again, on the nominal level, right, in terms of the definition of an uptrend, the uptrend's there. I can't deny that, but I definitely can't question the conditions underlying that rally. And there are a couple of things that I'm I'm a little bit concerned about. Breadth is one of them. All right, looking at the Magnificent Seven and friends, we've got 1.4% higher for Amazon, and that is your top performer. So not a great day for the Mag 7 here. Tesla and Meta both up today. Nvidia and Microsoft were basically flat. On the downside, you have Apple down 1.2%, about the same for Netflix, about the same for Broadcom. Palantir earnings, of course, we'll talk about in a moment, but most of these companies reported earnings last week, and it was honestly mixed, right? I mean, you had Microsoft and Meta getting dinged pretty good around their earnings report. You had Amazon and Alphabet just lighting it up. Apple doing okay post earnings. So it really was sort of a hit or miss kind of environment. Having said that, these 8 to 10 stocks represent a huge weight in the. There's actually 9 as I'm visually counting them. These 9 names and the S&P. 9 names represent a huge weight in the S&P and certainly a huge weight in the NASDAQ 100. So those are mixed. The benchmarks are mixed as well, skewing slightly negative. All right, let's get to the heat map. As a reminder, keep your questions coming. I see a couple questions that we might grab later, but please keep them coming. And if you're watching the replay later on our YouTube channel, please just use the comment section there. We'd love to hear from you. And I hope you go back and check out Friday's mailbag episode if you missed it, taking some time to answer some really thoughtful questions from you guys over the last week. And I hope you find time well spent. There's some really, really thoughtful questions, and I hope some very helpful answers there. All right, so looking at the heat map, I mean, this was not a great day, but for me, I don't know about for you, but for me, my eyes are immediately drawn to the center of the heat map. That's the consumer discretionary sector, because there's a lot of red. And again, this, when you think about this market going higher, right, and what is causing this, and I've had a lot of questions along these lines about how can the market be going higher given the fact that headlines from the Middle East seem kind of negative. The economic implication just seems very clear, to some, that like obviously these are all the things that are could likely go wrong. This is why the economy could not do well given all of this disruption to global supply, et cetera, et cetera. What I would tell you, having interviewed a number of people, particularly on my podcast, you can go back to some of the earnings related interviews with Nick Rach of the Earnings Scout, with Alex Carto of EPS Momentum, of Tom Bowley just last week, which is a really fun interview that I'd encourage you to check out. Consistent theme there is like, look, earnings are good. This earnings season has gone pretty well. Companies are earning money and their projections are not going down. This market goes down if companies in their earnings report say, we've got to guide lower because all these higher oil prices and stuff is killing our demand. Inflation is going to be a huge problem. We have to completely downgrade our expectations. There are very few companies saying anything closely related to that sentence that I just said. To the contrary, they're saying things are great. They're saying, look, we're raising our estimates. They're saying, look, our guidance is going up. We're making a ton of money. We're planning to make even more next year. That's the language you're getting during company earnings. And so there's a huge disconnect, I would argue, between the headlines we are seeing talking about and considering some of the macro forces that could be negatively weighing on the markets versus the earnings and the companies telling you things are great, particularly in technology, but not just in technology, in other areas of the market as well. Now, when that language starts to change, that's when I would tell you you have very good reason to start to get very, very concerned, because when companies start telling you all this stuff, all of this noise is no longer noise, but it's really starting to impact our top line and our bottom line expectations. that's when we can start thinking about the market going full on risk off. Now it's just short-term fluctuations while the long-term trend appears to be pretty good. That was a long-winded soapbox moment. So let's talk about some of the specifics. Within the consumer discretionary sector, I would say, a lot of red in here. And it's not just one group. It's things like home builders. And these are, there are specific areas of the market where higher rates can weigh on the group. Home builders and interest rates are an obvious one, right? Higher 10-year yield means mortgages are going to be tougher. And that means less people probably keen on buying a new home. And that is affecting all the home builders today. DHI, Pulte Home, both down 3.4%. We're seeing downward move in gambling stocks like LVS and cruise lines like Carnival, in the home improvement names like HD and Lowe's, both down 4% odd. So this was a pretty broad decline across the consumer discretionary space, except for three names. The two biggest ones, Amazon and Tesla, which were both up today. Amazon, of course, is more of an internet kind of its own sector kind of name, with the other Mag 7 having just, things are great, nothing to worry about kind of April continuing into May. And Tesla continuing to bounce off of like 330, 340 recently. Would also note eBay, which made a new 52-week high today after takeover discussions happened just recently. But I would say the broad decline in the consumer space, that's the kind of thing that doesn't feel great, just because the consumer sentiment can be an important component to this as well. And what would cause companies to start downgrading their expectations would be signs that consumer behavior is really starting to change. So not thrilled that we're seeing that in the consumer discretionary sector, particularly a lot of these, clearly discretionary things like travel, tourism, things like home builders. Those are things you'd want to see doing a little bit better. Other things that are looking negative, the materials sector having a bit of a struggle here. Linde, LIN, has been it's the largest stock in the materials sector in the XLB. That chart stands out to me as one of those charts showing a pretty clear divergence right about now. So we've mentioned in April, right, new highs on weaker momentum. So the RSI overbought in February as we're making new highs. That's good. We're making more new highs in April, and the RSI is down around 60. That actually speaks to the fact that the momentum is much less strong, even though the prices are still kind of drifting higher a little bit. LIN, by the way, closed below its 50-day moving average today for the first time in 2026. So maybe a potential breakdown there. We're watching the momentum to see if the RSI breaks below 40 on a chart like this. For now, kind of holding in there, but a potential cause for concern. Kind of mixed bag of elsewhere on the heat map. Last sector we'll spend a moment on would be the technology sector. Some negative standouts, AMD and Intel. Intel has been one of the better charts, right? I mean, just has lit it up, going from 50 to 100 just in the month of April. Just in the last month, the thing's doubled. Pulling back today after testing $100 a share on Friday. AMD down over 5%. To be clear, these are clear uptrends, making higher highs and higher lows, but coming off of that, ridiculously strong April into Friday, we're coming off a little bit. Things that are working just fine, Western Digital, and it's encouraging to me that charts like SanDisk and Western Dig, Seagate's in here somewhere, STX, these are stocks just continuing to make new 52-week highs every week. Micron, another one going up there. So that euphoric kind of AI play is still alive and well in some of these charts for sure. Other observation I would say is out of the top, the 5 largest stocks in the XLK, only one of them, Micron, was up today. The rest of them were actually flat to slightly lower. So that's why technology as a sector did not have a particularly good day, even though a number of stocks actually moved higher. CrowdStrike was another one of the names that I featured in that top 10 charts list on Stock Charts TV earlier today. In the software group, having a nice 3-month high to start the week here. But overall, I would say the largest names not doing well is the story. Energy doing just fine, of course, as long as crude oil prices remain strong. That's about it for the heat map. We're going to go on and talk about some charts that I have hand selected. While we get those ready, I do want to give a shout out to one of our partners, EPS Momentum. If you go to marketmisbehavior.com/EPS, you can get 30% off your first payment on a new subscription. It's a relatively low-cost product with some powerful capabilities to help you look for stocks demonstrating strong price trends and strong earnings expectations. We talked about this market being driven by earnings optimism. This is one of those tools I have found very helpful to find individual names showing that positive earnings momentum. Thanks to the folks at EPS Momentum being partners to the channel. Again, go to marketmisbehavior.com/EPS to learn more about some of their fantastic proprietary tools to help you understand the price earnings relationship. All right. Hey, on Friday's episode, if you tuned into the mailbag, we talked about a little bit of market stuff to start off. We talked about the shooting star candle that we noticed on the chart of the S&P 500, on the chart of Apple, and a handful of other kind of important charts going into the weekend. And our comment was, does not set us up for a strong start to the week. Tells you the next 1 to 3 bars more likely weaker rather than stronger. Sure enough, we're seeing weaker action in the S&P daily chart there to kick things off. However, we did make a new all-time high on Friday. We did close above 7,200 for the first time in history on Thursday of last week, and we're right about at that level. So we are still at or near new all-time highs. I always tell people be a little careful about saying, all right, that's the top. Calling the top sounds like something that should be a lot of fun. It's very easy to get wrong, and I would argue a fool's errand in a lot of ways. I don't think pinpointing a top or bottom really gains you that much compared to the amount you lose by being wrong on that call all the other times, which we don't tend to focus on. So, in the short term, remember, an uptrend, if this is a continued uptrend, we're going to have pullbacks. This is why looking at things like the recent swing lows around 70.50, looking at the 21-day EMA, that's kind of our initial release valve. As long as we're holding that on a pullback, things are still pretty good. And it certainly seems like things are pretty good right now. We're still very close to the overbought region. I would say this trend is still very much in good shape. Certainly feels to start off with, we have a bit of a tactical pullback to start the week. We got a lot of earnings over the next couple of days that could change that trajectory very quickly. But overall, kind of a risk-off start to this week. So again, we're kind of watching 70.50. 7,000 was an important level, and anything above there we consider still pretty bullish. Breaking below 70K, that's where 77K, that is, we would start to be concerned about a potential deeper drawdown. I mentioned the uptrend that we've seen in stocks has not been supported by greater breadth, and we saw that over the last couple of weeks. The advanced decline line on the New York Stock Exchange has been trending lower since mid-April, as has the advanced decline line on large caps and mid caps. The small cap 80 line is the only one that actually made a new high last week. And so I think that tells you the strength has been in small caps. It's not been elsewhere. These are not updated through today's close just yet. Not all of them. The top two actually are, but these next two are not. Having said that, weaker breadth to start the week certainly seems like the advanced decline lines are going to start to rotate lower, continue to rotate lower, which is a trend we've been observing. So one of the concerns about higher stock prices not supported by stronger breadth conditions. We're also seeing some weaker action in gold. This is the GLD, and I zoomed in a little bit just to show the fact that, look, we gapped below the 50-day. We then had this great counter trend rally back up to the 50-day and now rotated lower. So this certainly feels to me like we're making lower lows and lower highs. I think as long as we hold kind of this area of support, we are nearing kind of the level, right? This is the swing lows from March, around $400 a share for GLD. The 200-day moving average kind of right around that level as well. So I think that's the level where you'd probably anticipate some support. Holding that is pretty important. Breaking that and the chart of gold looks really ugly really quickly. I'm not impressed by the failure to recoup the 50-day moving average. I'm not impressed by the weaker momentum as we try to make a push higher. RSI didn't get much above 50. So the momentum's telling you we're already in a pretty good downtrend, and I'm concerned about that trend in gold. I've been lightening up my gold position through April, and now still have some, but I probably always will have some gold in there. I think it's a good diversifier, but not my favorite chart right now. I tell you what, the VIX is remaining fairly low, and the bottom panel in purple, that's the VIX, right? This is the S&P index options market. So looking at the options market to sort of imply volatility for the S&P 500 itself. VIX below 20 tells you it's a low volatility environment. The VIX has been remaining low over the last couple of weeks. I think that's been a pretty encouraging sign. This is the MOVE index in the top panel. This is like the same exact thing, but for bonds instead of stocks. So we can look at the options market relative to bonds and see what that volatility is telling us. it's not the same. The numbers are different. We don't have that 20 level like I talk about with the VIX, but just looking at the trend in the MOVE index, look how the trend was going down from late March to mid-April. That tells you, again, bond markets, or at least the options market, are telling you not a lot to worry about in bond land. But look at the last couple of weeks. While the VIX has been kind of steadily trending lower and remaining low, the MOVE index is starting to turn higher. So the options market's actually telling you bonds are actually signaling a bit of a risk here, or elevated risks. So bit of a concern. It's almost like being reflected in the bonds before it's being reflected in the equity options market. An emerging theme that we'll continue to monitor, but that's one kind of red flag that I'm seeing would be a spike in volatility in the bond options, basically, is how I would summarize that. Rates are going higher as well, and this is one of those warning signs. I think the 10-year yield still has room to go and still be okay, but just higher rates at this point, I would argue, probably are not a great thing, only because the economy and the fantastic earnings projections, I think, are going to be driven by companies growing, and a lot of companies don't need cash to grow. But even some of the biggest companies have been borrowing aggressively to get all of the AI infrastructure built out. We've just seen headlines, more and more companies making huge investments in AI and AI infrastructure. That all costs money, and not every company has endless supplies of cash to throw at this kind of thing. But there's a huge risk to being behind the curve, and they're all feeling that. So there's like a AI infrastructure FOMO happening in the equity space. I just would argue that means companies are going to have to borrow money. And if it gets more expensive to borrow money, I just don't think that's going to end up being good for those companies. So we'll see. For now, rates are going higher, and that is sort of another risk-off move, I would say, at this particular moment. 10-year yield getting very close to 4.5%. We haven't seen that level since Q2 of 2025, almost 12 months ago. So it's been a while where the 10-year yield has been relatively low, kind of around the 4 to 4.25% range. Now we're up in the 4.25% to 4.5% range. We get about 4.5%. I think we have to talk about the concerns that higher rates could start to be felt around the markets. Crude oil going higher. And again, I love keeping it simple. I would say generally crude oil sticking above $100 a barrel for whatever reason is probably not going to be a great sign. And again, to someone's point I see in the chat, 100% right. I mean, crude oil and interest rates generally kind of tied together here. You're going to see the correlations pretty high between those two. Higher rates, stronger crude oil prices, all kind of in alignment about pressure, economic pressures, and I would say not side effects, but definitely things feeling the direct impact of events in the Middle East, right? Before things kind of got absolutely haywire, crude oil's down around $60, $65 a barrel. All of a sudden, we're getting close to double that here. So crude oil above $100 a barrel. Again, I would say the longer that we kind of stick up in this range, even if it's flat for a while, those higher crude oil prices start to weigh on things, because that starts to trickle down into other areas of the market. That's where supply pinches really start to affect things. That's where it could change consumer behavior. So bouncing off of $100 a barrel, which is where we sort of were through the end of last week, higher crude oil prices here would be a dangerous situation. We're seeing that bounce because of the latest headlines in the Middle East, which tells me more negative headlines. There's no, specific upper end. I mean, at some point, crude oil prices get too high and then it naturally starts to come down probably, but I don't think we're at that break-even point, or that breakup point. Apple, similar to what we talked about with the S&P 500, showing us shooting star candles. So not surprisingly, I would say if you follow candle charts, today down. And so that's what candle charts are designed to help you understand, right? Short-term sentiment on Friday was gap higher at the open, trading much higher during the day, but closing back at the lows. And that implies a lack of willing buyers, a lack of demand. And that means the next 1 to 3 bars more likely lower. And we're seeing that today. For now, we're kind of holding this gap, which was caused by Thursday to Friday. 276 on Apple is kind of a tactical level of support, which is right about where we're at going into the close today. Something to watch. But for now, I would say great, initial reaction to earnings, but not a lot of follow through on the chart of Apple. And that's after facing some pretty significant resistance on the chart of Apple. All right, this is the third and kind of final big, heavy fire hose kind of earnings week After this, it'll start to lighten up a little bit, but we will have to talk about earnings through the course of this week for sure. I did want to highlight Palantir, which is set to report today. Kind of a nothing burger kind of session. Palantir's been very range bound here for the last 3 months. Since their last earnings report, which is the beginning of February, it's basically been range bound. Market's been telling you about 145 is kind of a fair value, and we've just been kind of ranging between 125 and 160, just kind of going above and below that median point. And the moving averages, the 50-day moving average, kind of flat right in the middle of that, level. Let's take a look at what's happening in the after hours session with Palantir. Not down by much. It's actually kind of flat here, 145.40. That's just down slightly from today's close. I mean, we're literally like right at the 50-day moving average in the aftermarket session. So no significant after hours movement, it looks like, holding steady here. So with the chart of Palantir, what do? I mean, this is one of those where I would argue on a chart like this, what you do is you basically draw a rectangle. This is the proprietary Dave Keller draw rectangle strategy, which is basically you draw a rectangle that kind of summarizes the action in the chart. That's about pretty good for me. What we basically said is, look, this is the range, 125 to 160. If you've ever heard of Darvis boxes, by the way, it's kind of based on his work, loosely based on kind of his methodology, which is kind of drawing these boxes around the congestion areas and then looking for breaks. What I'm basically outlining is, look, one of two things is going to happen at some point. And until then, I think you just wait. I think you're patient. Break above 160 would mean a move above the 200-day moving average. That would be a very bullish resolution to this chart. Break below 125 would be a new 3-month low. That would undercut the February and April lows and imply that the buyers that were coming in there kind of no longer around. And so that would be pretty bearish. In the neutral, it's kind of yellow light, right? Green light above 160, red light below 125, yellow light in the middle. We're in the middle of the yellow light kind of district. I think it's telling you to just wait and be patient. That's the chart of Palantir. No big movement, it looks like, relative to earnings. Home Depot, I mentioned all the weakness in the consumer discretionary sector today. It was all over the place. Outside of those top couple names, Amazon and Tesla in particular, then like eBay, which is an upside outlier. The rest of the sector, pretty ugly. Home Depot and Lowe's are not great charts. Home Depot actually made a new 52-week low today. This is after making a counter trend rally to the 50-day moving average and failing, and now undercutting these previous support levels. I mean, Home Depot is just not a great chart right now. So a chart like this, I tend to bucket as guilty until proven innocent. I'm seeing negative trend, negative momentum, negative relative strength. No reason why I would want to take a shot on this until I start to see improvement. Retesting moving averages and actually showing some accumulation, momentum flipping, relative strength flipping. Weekly MACD is one of the indicators I would use in these kind of situations. We don't have time to go into it, but that's my suggestion. If you're thinking about Home Depot or Lowe's, for me, I'm patiently waiting for enough accumulation. The weekly MACD usually reflects that pretty well. There are great charts out there, and I think that's one of the important things to remember in this kind of environment. I'm finding a lot of things that are getting me, little like not so ideal kind of charts, especially outside of technology. However, there's some great charts in a lot of different sectors. Here's two I'll highlight for you. CBOE is in the financial sector. I mean, it's an exchange, but it's really more of a data provider at this point, along with the other exchanges. They're all in the data business more than anything else. But a gap higher on Friday, followed by an additional gap today. They just reported earnings at the end of last week. It went pretty well, but when you have a gap higher like this, I always say we want to see if there's follow through, right? What about that next session? Are people continually wanting to pay more, right, after that first gap? And I think today's follow through really suggests a nice uptrend breakout, and a nice continuation for the trend CBOE. I might have two more charts. No, just one more. Take-Two Interactive, TTWO. This is in the communication services sector, right? It's a software play, or it's an internet play. I just want to note this came up on a scan. I was running a scan for new 3-month highs earlier today, new 13-week highs, and Take-Two came out. And I love the fact that it broke out of this consolidation. Think of that box that I drew on a couple charts ago, whatever that was, Palantir, where you had kind of this sideways trend. You could draw a similar rectangle here, wider range, but break above 220. I think we've really followed through to the upside. I'd love to see continuation above the 200-day, but I like the breakout, the new 3-month high, the break above resistance, the stronger momentum, follow through tomorrow, which suggests further upside for a fantastic emerging play in communication services. All right, let's take some questions. Yeah. 3P Investor, thanks. Fellow Pacific Northwesterner Keith Fitzgerald is in the Seattle area. I have had him on my podcast. He's always hot on Palantir. That man has been optimistic and appropriately so on the AI trade. I did see a note of his. We were talking about Palantir. And he's making the argument that these are great companies reporting stellar earnings and great expectations. I can't disagree with any of those things. And the charts generally are going up. But what's interesting to me is Palantir has not been, right? Palantir has actually not been trending higher. So I buy into the great companies doing great things argument when the chart tells me that the investors are rewarding that. Palantir's had a crucial missing piece to that argument. But point well taken. And I think, Keith usually is a great source of optimism, long-term optimism on these growth stories. And that's been the right play in recent years. Cannot disagree with that at all. Let's see what else. There's one other question I saw earlier. Yeah, Michael, thanks for watching. The VIX jumped big today and the war would get worse now. I mean, maybe, right? So that, and again, it's not, I mean, it's, we want to be careful on cause effect, right? I mean, a higher VIX doesn't imply something crazy is going to happen with a military conflict. However, what it does tell you, right? The VIX, think about what it's actually telling you. The VIX is telling you about uncertainty and fear. Right now, we've had relatively low fear, right? And what that means is that the market is not pricing in significant movements in indexes because things are kind of okay. When you're looking for what indicators would tell me things are not okay in the mind of investors, I would say the VIX probably one of the better things. Even with the conflict, and there have been moments here just in the last month where it's felt like things were maybe going to kind of get worse very quickly, or certainly things were not getting dramatically better. Right? We weren't getting a resolution. We're not getting a treaty of some sort that kind of rounds this out. It's still sort of just kind of looming, but volatility remains low, which means investors are seeing limited impact. A spike in the VIX would tell you investors are starting to see a not so minimal impact and starting to see a more significant impact. And that could be a real issue. All right, folks, listen, thanks so much for some thoughtful questions. I couldn't get to all of them, but I will add some of them to the mailbag. If you missed Friday's mailbag episode, please do yourself a favor and check it out because there's some great questions. And I think could be a great opportunity to learn a little bit about maybe areas of the technical toolkit you may be less familiar. Also, recent podcast episodes have been a lot of fun. Just in the last week, we interviewed Wyckoff expert Bruce Frazier and Tom Bowley. He called exiting chair Jerome Powell Mr. Waffle House. So we played on that with the interview, but I will let him explain in his own words why he called him that. It was actually a pretty entertaining story, but check out that podcast as well. In the meantime, have an awesome night. And remember, it's always a good time to own good charts. Take care, folks.